My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to make you a little money. My job's not just to entertain, but to educate, teach. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. When we look back on this market in this year, at this moment, we're going to see two things. First is a steady ramp in the S&P 500, and then some moves that seem like alchemy, but were really reality. It's easy to just park your money in an index fund, isn't it? That's the conventional wisdom. And today it did okay. Dow advancing 47 points, S&P inching up 0.02%, NASDAQ dipping 0.26%. But I think you should own more than just an index fund, because buying individual stocks with special characteristics is how you can rack up some really serious gains. That includes often scoring speculative stocks. Far too often we become snobs when we talk stocks. So many experts think that if you venture past the index, you could fall off some sort of intellectual cliff that makes any gains null and void. It's as if the huge swath of points you could have gained simply don't count. But that, people, is nonsense. No one in a bank is ever going to say, wait a second, did you make those gains in Kava? I mean, that isn't fair. You need to be at McDonald's. Did you really buy Carvana? I mean, come on, you should have purchased AutoNation or Ford. The banks don't care where the profits come from, people, and you shouldn't either. Oh, and did I mention you would have made a lot more money from Kava and Carvana than the much less speculative situation I just mentioned? That's why I come tonight to praise speculation here. I'm the only one on TV who actually does this, believe it or not, and show you how well you could have done if you picked some high flyers for your portfolio and simply held them for the long ride, along with your prosaic, precious index funds. I'm not excluding one for the other. So tonight I'm going to tell the stories of stocks that have rallied more than 200%. 200% this year alone. Stocks with market capitalization of more than $1 billion, because frankly there's simply not enough time to go over all of the smaller ones. And because it is so joyous to see people making so much money investing in new young companies, maybe you need to think about it. I'm going to give you 10 of them, going in ascending order. First, last night was a tremendous night for wealth creation, including the outstanding gains from Rocket Lab. That's a soup-to-nuts space company that's been putting up a plethora of satellites that will only grow exponentially over time. They just reported 55% revenue growth with a $1.05 billion backlog. Rocket Lab. I get asked about this one all the time in the lightning round. You know that. I'm calling it accessible because you could have listened to our callers and you would have bought it. And today's run, the darn thing's up over 240% for the year. The second smallest gainer in this group of just hallowed stocks is the most salient, and that's Kava Group, which reported last night. This casual dining chain aspires to be the Mediterranean version of Chipotle. It's up over 242% for the year, including today's 1.5% gain. At one point, it was up so much more because the same-store sales were up 18%, and Wall Street was only looking for 12.4%. The best thing about Kava is this one was indeed accessible. Many of you have eaten there and enjoyed it. Right now, the stock stretched a little thin, with each restaurant in the chain worth nearly $48 million on average. Way too expensive. But who's to say that this $17 billion chain might not eventually make its way to Chipotle's levels, which is over $80 billion? Next, we have all hail Palantir, the cybersecurity company and defense contractor that's ascended to the cult stock status like GameStop, except for it's good. CEO Alex Karp talked a big game until the recent quarter when Palantir soared on an amazing 3 months that verified his chest pounding and ratified the stock's run. It's now up 253% for the year. Yeah, it's doing better than NVIDIA. The big gains have come from revolutionary Defense Department contracts that could bring our stodgy military bureaucracy more in the cyber warfare era. Oh, by the way, these guys really excel in one thing, most definitely, the procurement process. Fourth, we highlighted Powell Industries back in August. No, not J. Powell. It's a real company. Here's an old line industrial that makes custom engineered equipment to control electricity. Their machinery is primarily used by oil and gas companies. But lately, Powell's become the supplier of choice for those who need critical electrical infrastructure. Made its terrific data center play, up almost 259% for the year. Next up, speaking of data centers, they consume just seemingly endless amounts of electricity, don't they? Which is why an integrated power producer, Vistra, is on the list, up almost 269% for the year. While the vast majority of its power generation comes from fossil fuels, It's 60% natural gas, 20% coal. Vistra's got nuclear exposure, and it's making some big investments in renewables. 6, when Carvana dropped to single digits last year, I pounded the table saying that people buy. Love this low prices and generous return policy. Having bought a car for them and then sent it back when my wife didn't like it. No accounting for taste, people. Carvana was in trouble, but then they got big backing from their creditors, allowing them to reduce their debt, and the rest is history. The stock's now up 353% for the year.
House of pleasure.
And again, I think it was gettable if you're willing to take some risk. All right, 7th, AST Space Mobile is another company that I've gotten a lot of calls about lately. It's a satellite maker, but it has deals with Verizon and AT&T. It helps smartphone connectivity. While it's losing gobs and gobs of money, it's a space stock, and space is love right now, hence why AST is up over 362% this year. Next, if the president wants to do a strategic Bitcoin reserve, he might as well buy stock in MicroStrategy, which owns 252,220 Bitcoin at the end of September, which is up 11.4% from the end of June. This was another company that seemed cockeyed because it was known as a business intelligence software company. There are many other smaller companies that have tried to mimic MicroStrategy's pivot, but why own a pretender when you can own the real thing, the one that's up nearly 419% for the year? Not all these big speculative winners are money losers. Take AppLovin, which helps software developers create apps. While it's been in business for 12 years, it still feels like AppLovin burst out of nowhere, doesn't it? Reporting earnings of $434 million. Analysts were expecting $319 million. That's called a beat. It has mobile analytics and in-house gaming division, and it's got an AI power acquisition platform that apparently everybody loves. And that's how you get a more than 612% gain year to date. That's right, 612% on a company that really isn't all that speculative. Finally, the best performer, viewers are crazy for nuclear power. You know that. You hear it all the time. Well, how about NuScale? That's spelled N-U. This one's on the come, so to speak, because it's losing a fortune developing the nukes of the future, so-called small modular reactors. Yet it's so beloved that I bet it can raise a ton of money once it lands a big hyperscaler contract. I'm clearly not alone here. The stock is up 659% for the year. Now, keep in mind, there are plenty of other names that I've had that have had great speculative runs. Some that just came public, Astera Labs, which makes semiconductors for AI and cloud infrastructure, even though the stock's up 148%. Let's not forget recent IPO Reddit, one of the hottest online platforms out here, one I've been pushing all the way. Stock's up 288%. Well, Astera Labs was definitely inaccessible. Who's going to know that one? Reddit was available to anyone who spends too much time on the internet, which is most of us. Now, here's a huge caveat. I'm not endorsing these stocks up here, given how much they've already run. I'm simply saying that speculative stocks have a place in your portfolio. And all these were speculative to one degree or another, except for AppLovin. A small position in any one of these winners could have trounced the performance of a much larger chunk of money in the S&P 500 index fund. And therefore, I don't think it's nearly as dangerous as people would bother to complain about. The bottom line, let's remember this list of frothy stocks and think of them the next time you're about to ignore a stock for being too speculative, because these names are often the epitome of speculating wisely, which can be the key for terrific long-term performance, of course, only when melded with index funds. Jerry in Missouri. Jerry.
Jim, thanks for taking my call.
My pleasure, Jerry. What's up?
Well, the last time we talked, it was October the 24th, and you were on an oil rig in the Gulf of Mexico.
Yes, I was. And I remember Regina Gilligan did not get sick at this oil rig. She felt great. My executive producer, of course, who's like over here. She was on the oil rig with me. Put some clothes on. Oh, it looks fabulous. Okay, great. Let's go. Well, look, when anyone acknowledges we're on an oil rig, I'm always going to think of Regina. Okay, go ahead.
So I asked you about a beaten down solar energy stock, and you told me not to sell down there. But now that we have a new president-elect, it's way down even further.
Yeah,
Should I hang on to my end phase or dump it?
You know, it's weird. The president-elect actually likes solar, but the market believes that doesn't mean anything, and that anything that's got China, anything that's got, need I say, subsidies, is something you want to avoid. I think you got to hope for a bounce. I mean, it's 52-week low today, 59. Go for a bounce, but then go, because it just doesn't have the horses. Look, speculative stocks do have a place in your portfolio. Pick one or two. I'm going to tell you, pick a boatload of them. And with the right amount of money allocated to them, the returns could trounce the performance of a much larger position in an S&P 500 index fund. If I could own individual stocks, I would certainly own one or two speculative situations. I can. On Mad Money tonight, fresh off its Investor Day, I'm hearing what MasterCard has planned for the future with the CEO. Then, with long rates soaring, should investors still consider a monthly dividend payer like Realty Income that's raised its dividend for, more than 25 years? I'm seeing if it's worth watching amid a pullback with the company's top brass. And Cisco reported after the bell, and I'm running through the major takeaways of my post-earnings exclusive with the CEO. Did the stock run too much? Stay with Cramer. Always keeping tabs on the big credit card companies because they have their finger on the pulse of the economy, and not just our economy, the world. Take MasterCard, which reported a solid quarter a couple weeks ago. Today, MasterCard held an investor meeting where they presented some long-term plans from 2025 to 2027. They're talking about revenue growth in the high end of low double digits, which is pretty darn good. I don't have a lot of companies have that kind of growth, especially a big one like this. The company also previewed a future where, get this, you can conduct credit card transactions online, simple biometric information like your fingerprint or facial recognition, rather than needing to manually enter your card details every time. So let's take a closer look with Michael Miebach. He's the CEO of MasterCard. He had a glimpse of where the company's headed. Mr. Miebach, welcome back to Mad Money.
Thanks, Jim, for having me. I'm very happy to be here.
Well, I'm torn, sir, about we should talk about how big you are and how many cards, but we also have to get to the biometric, because that would make all of our lives so much easier. Let's start with the scale of this $500 billion company that people don't know enough about. How many lives do you touch?
3.4 billion MasterCard payment credentials out there. We're talking billions at MasterCard.
And how many countries?
220 countries and territories. So basically around the world, now including China.
Now, when I looked at the numbers, I keep thinking, well, isn't it all tapped out? Doesn't everybody have a credit card that needs one? But then you've got some figures about cash and checks, and they're still mind-boggling how many people are still in the Stone Age.
So if you look around the world, it's an uneven picture. We have highly digitized economies, but we also have fast-growing economies. Think Africa, think Latin America, think of Asia, of course. In Africa, 90% cash. But go to Europe, where I'm from. Italy, Germany, significant amounts of cash, 30, 40%. For the industry, when you just look at consumer to merchant type of payments you pay in a store for a good or a service, it took the industry multiple decades to card $23 trillion. And you would say, that's a lot. To your question, does everybody have a card? There's another 11 trillion out there. And that is with a growing economy. So the pie is only going to grow. But one other thing that is happening, which is a big opportunity for us, is there's all these emerging new business models post-COVID. It's the delivery economy, there's a shared economy, there's the gig economy, which turn what used to be one payment into multiple payments. Think you order food. So you order food in a restaurant, you pay with your card, fantastic. You order food online and have it delivered. There's 3 payments at least, to the courier, to the restaurant, to the app, etc. So plenty of opportunity in terms of growth.
Now, I like the fact that there's underpenetrated verticals. Utilities, I never thought about government. Healthcare still, housing still. These are not digitized?
They're not digitized in convenient ways. So occasionally there's check payments. There's not that much cash, but there's a lot of check payments. But just imagine it's as easy as paying with your card. Tremendous potential, and cost and more effective for the companies involved and for the consumers.
Now, I think all of us can't believe that we're still, like in 2000, typing in our credit card number, which we're always trying to look and see what that is, the CVC, and why is it that these are even relevant these days?
Well, they shouldn't. They shouldn't. Just today, we made an announcement that by 2030, we want to do away with one-time passwords. We want to do away with keying your card number into an online site. It should be as simple as it is in a store. What do? You tap. These are highly secure payments. You tap, you walk out with the good, the services when you pay it in a restaurant. Why doesn't it work like that online? Well, it can. The technology is there. It's called tokenization. You basically take your card credentials, the long 16-digit number that nobody can ever remember, and you put it in a one-time token, and that is provided by your bank to the merchant, and there you go. Nothing to be putting in. And the next step really is, when you open your phone today, your biometrics are stored in the phone. It will recognize your fingerprint or your face or whatever. Why isn't that possible when you're on your browser, do the same thing? That's exactly what we're pushing for. So goodbye to one-time passwords. Hello to one-click checkouts that are biometrically authenticated.
I don't think people realize that you are at the forefront of cybersecurity, and that's why a 2030 estimate, you actually have the ability to make that call. Most other companies do not have the cybersecurity that you have.
Yeah, it's been a very strong suit. I mean, we grew up in the payment space, but the question was from the beginning, how is a MasterCard payment the more secure payment? So we built out a whole of capabilities around fraud management, authenticating, is it really Jim who's paying, or is it really Michael who's receiving the payment, and so forth. Now it went into device biometrics. How fast are you typing? Is that, could it be you or is it somebody else? Different pressure, geolocation information. There's many pieces of information that are not personalized data point, but data points that can prove with high security that this payment should go through. So we've been a force in cybersecurity. Now we're going beyond that, and you look beyond the transaction. What are cybersecurity threats? So we're really starting to become a very strategic partner for our customers, banks, large merchants, to talk about cybersecurity in general. If you add up a whole part of our services business that's not pure payments, it's almost 40% of our revenue today.
People don't know that. I'm glad you brought it up. Now, I also want to mention you dropped that number about China, how big China's become very quickly. Right. I know Russia out, didn't even blink. Numbers weren't hurt at all. China, additive. Latin America, only 9% of your world is Latin. You could probably double that given the nature of those economies.
Significant opportunity. We're truly global. We talked about it earlier, 220 countries and territories. Tremendous potential in geographies around the world. China, very unique for us, as in we have a domestic license in China, which we got last year, and we're now building out the acceptance of payments. The Chinese banks are issuing cards in China. The unique difference here is for the Chinese consumer, they used to have a card that only worked in the country, and they had a different card that used to work abroad.
That's
now there's not going to be one card. Tremendous potential, and the Chinese economy, up and down and left and right, that is not so much our concern. We're putting a tool into the hands of the Chinese consumers and connecting the Chinese economy to the rest of the world.
That's a nice driver. Now, I need you in the time left to settle a bet I have with my colleagues David Faber and Carl Clinton in the morning. I continue to say that Europe is much stronger than people realize. We get that from Amazon. I've got that from Apple. I've got that from Banco Santander. 33% of your business is Europe, 34% North America. Tell me how strong Europe really is.
So Europe for us has been a tremendous growth story for a couple of reasons. First of all, Europe was catching up on digitization. So higher levels of digitization in the US. Now Europe's got caught up, and it was really in the wake of COVID, because everybody learned new habits. It was the same here, but it was the same over there, but starting from behind, now catching up. So that's a tremendous driver. The second driver really is tremendous share gains for us. So on the base, we have heavily invested in Europe in our infrastructure, in our technology, and in product propositions. And that's on the consumer side, as well as on the commercial payment side. So if you look at the UK, now a third of the UK debit card business is with MasterCard. That was a very different picture 5-6 years ago. If you look at some of the big pan-European banks like UniCredit, strategic partnership with which we announced, Deutsche Bank, strategic partnership with which we announced. So it's been a tremendous story for us, and we're now a leader in Europe.
Well, I think you've got great growth potential for many, many years, and I should tell people it's secular growth, meaning it really doesn't have a lot to do with the economy. It just happens to be these bigger trends that Michael Miebach, CEO of MasterCard, is riding. Thank you so much for coming on your very big day, Michael.
Thank you, Jim.
Mad Money back. What a very strange moment here. The Federal Reserve is committed to cutting short-term interest rates, but long rates set by the bond market have soared. And that's holding back all sorts of stocks, especially the high yielders that most directly compete with bonds. Take Realty Income Corp, the real estate investment trust that owns more than 15,000 properties, mostly retail focused. This REIT is famous for its reliable monthly dividend payments, which currently yield more than 5.5%, substantially better than you get from the bond market. However, the stock would be a lot more enticing if long rates were going down rather than going up. Don't forget, these guys are dividend aristocrat. Realty Income rallied 20% in the third quarter in anticipation of that first rate cut from the Fed. But as long rates have climbed relentlessly in October and November, the stock has been crushed. Didn't seem to matter. The REIT reported a very solid quarter early last week, even raising its full-year forecast. So what do we do with this high-quality dividend stock now that it's pulled back from its highs? Let's check in with Sumit Roy. And he's the president and CEO of Realty Income to get a better sense of what's happening. Mr. Roy, welcome back to Mad Money.
Thank you very much for having me, Jim.
Okay, so help me here. You know, you just reported great numbers. The dividend, safe, keeps being raised many, many years. We love the monthly dividend. We look at the stock and we presume that there must be something wrong. Could you please explain to people that it has much more to do with long rates than it has with your portfolio?
Exactly right, Jim. The exogenous factors here is absolutely the 10-year Treasury. Even if you just look at what's happened over the last 6-7 trading days post-election results, it's trying to find where the settling out period is going to be, and it's gone up about 30-40 basis points during that period, which obviously has an impact on our stock. You know, the things that we can control, like you said in your introduction, our ability to continue to perform regardless of the volatility that we are experiencing. That's what this company is built on. We are a highly diversified, 80 billion plus enterprise value company that believes in distributing dividends. And we've done that since our listing in 94 every year. And I think this too will pass. The market is trying to adjust what are the policies that will come through, what are the priorities of this policy, and what's going to be the inflation expectation longer term. And as soon as that happens, I do believe that backdrop will be very conducive for us to continue to perform.
Well, I have to believe that historically the relation between, say, the longer-term bond and you is such that if you bought it when the stock broke down, and this has happened twice to me with your company in the last decade, it has always been the right thing to do. And I'm therefore presuming, at least historically, it would be the right thing to do again.
Yeah, you're absolutely right. In a rising interest rate environment, which is what we experienced, from 96 to almost 2006, in that time frame, the 10-year was trading north of 5%. It wasn't necessarily a rising interest rate environment, but it was an elevated 10-year Treasury. We continue to perform. We grew our AFFO per share, which is a proxy for our earnings, at a 5% level. Then in an environment when you look at 2008 to 2022, where the 10-year was somewhere in the slightly north of 2%, we still continue to perform and generate earnings north of 5%. So for us, it's not really where the Treasury, the 10-year Treasury ends up. You're right, in the short term, there's an inverse correlation. It's just once that volatility is out of the market and we have a stable backdrop to execute on transactions, that's what we are able to do. And so, like I said, there's a bit of a feeling out process by the market to absorb what are the policies that are going to dictate the next 3 to 4 years. And once that happens, I think we'll be in a good place to continue to be that net lease company of choice.
All right, so let's be sure that some people are saying to me, Jim, you're whistling past the graveyard. They've got a big position, a tenant position with Dollar General, big with Walgreens, big with Dollar Tree. These are no longer the kinds of credits that you want. How do you respond to that?
For me, there are the headlines, and we discussed this during our earnings call last week, where they talk about $600 Walgreens stores closing down. And the reality of the situation is we had 13 Walgreens coming, had lease expirations this year, and all of them were sort of renewed. And so it's a similar story with our Family Dollar situation. In our history, we've had more than 100 leases renew, and we've recaptured north of 106%, 107% renewal spreads. And so, the reality does not sort of match up with the headlines. It is true that Family Dollar as a brand is going through some growing pains, and that was one of those M&A transactions that Dollar Tree did, which hasn't sort of come to pass. But that too is going through a repositioning. And I think we've touched on this before in your show, Jim. We buy assets that we believe has a slew of alternative tenants ready to come in. And even in a situation where we do get back assets, we're very confident in our ability to reposition it. And that's been the case on some of the Family Dollars that we've actually proactively approached Family Dollar and said, can we have those back? And because we've had a couple of very large national retailers who want to step into that position. And so we feel very confident about our ability to continue to produce results, regardless of some of these headlines that dominate, the news.
Well, I'm so glad you said that. To me, it's just been entirely related to 10-year. Very, very rarely do you get this kind of break to be able to buy your stock, which is a straight-up stock. I want to thank Sumit Roy. He's the president and CEO of Realty Income, letter O, monthly dividend risk out for more than 25 years. Mad Money's back after the break. All right, what do we make of these results we just got from Cisco Systems, the networking titan with a rapidly growing software business? For the past couple of years, we've waited patiently for Cisco to turn stuff around as customers work through excess hardware that they ordered during the pandemic. Finally, this August, the company shut the lights out. Stock ran up 33% from the August lows through today's close. Tonight, Cisco reported another very strong set of numbers. 4-cent earnings beat off an 87-cent basis, higher than expected sales. Even better, management gave excellent guidance for the current quarter and raised its full-year forecast. Then after a quick pop when the numbers came out, the stock settled back down. Look, we can't control that. But did Cisco simply rally too much going into the quarter, borrowing future from the upside? Or maybe people are going to realize that it's a very inexpensive stock and buy it again tomorrow. Let's go straight to the source with Chuck Robbins. He's the chairman and CEO of Cisco Systems. Learn more about the quarter and what comes next. Mr. Robbins, welcome back to Mad Money. Congratulations on another strong quarter.
Hey, Jim, thanks for having me today. I'm really proud of what the teams have accomplished. And you referenced the strong finish to the quarter, the strong guide that we put out there. We saw strong demand. We saw strong AI demand, so we're pretty pleased with where we ended up.
It looks like that it's a recovery across the board in the enterprise, and even telco has gotten better. How could we be getting all better all around the globe, including, by the way, Europe?
Yeah, so Jim, if you look at the product orders that we put up, this is excluding Splunk, just on the organic side. Clearly, they're positive with Splunk in there, but we saw Europe and Asia both up in the teens. We saw the Americas up in mid-single digits, but you have to normalize out, or if you normalize out U.S. federal, which was a little bit of a drag given the continuing resolution and the Fiscal Responsibility Act, as we talked about on our call. I mean, overall orders were up mid to high teens, notwithstanding U.S. federal. So we saw strong demand everywhere else. You mentioned telco, which we saw return to positive strength. We saw some activity in Europe. We saw activity in Asia Pacific. And then perhaps the most exciting area for us was our cloud customers, those web scalers. They were up triple digits year over year, and 4 of the top 6 were individually up triple digits year over year. So we saw great balance around the world and across customer segments.
I think it's important to point out that Meta is obviously a great customer and doing a ton of business, and that I happen to think that Meta is probably maybe ahead of everybody right now in terms of money they're spending to do AI and to introduce new products. This has become a great customer of yours.
They are a great customer. They came out and recently talked about their use of one of our products in their back-end networks, and I'll let them explain the use cases as they see fit. But I think it's just indicative of what we're seeing with this AI evolution. We see the success we're having in the what's called the back-end networks, where these training models are running. We have both the infrastructure underneath the GPUs. We're selling super spine infrastructure, which basically connects different clusters of AI. And then we actually provide both systems and optics, which is really important. The optics are very important to actually connect that back-end training network to the traditional cloud front-end network that's actually serving the enterprise customer. And then there's tons of great stuff going on in the enterprise as well. So AI is really coming to life.
I do need to hear, what are they doing with it, Chuck? They're spending a lot of money. A lot of people feel they're overspending. They must be using it correct. These are smart companies. They're not just throwing money away.
Well, I think what they're doing is they're preparing for the access that's going to come when the enterprise begins to build applications. We talked about what's happening with the enterprise customer today, and there's two things that we see happening as a result of AI. The first is they're upgrading their traditional technology infrastructure just to be ready. I think the pandemic, as an example, caught them off guard. They weren't quite where they needed to be. And this AI wave that's coming, they want to be ready. So they're upgrading all their technology, which is what you saw with our enterprise performance. The second thing is many of them are beginning to deploy AI applications, which once they get to scale, that's going to be when I think the web scale and the cloud players who have been building out these training models, those enterprise applications will need to utilize both the data coming out of those models as well as capacity on the front end of those cloud networks. So these are smart customers, and I think they see the long game here, and I think they see as the enterprise builds out those applications, they'll monetize that further.
I agree with that. When I talk with these people offline, they tell me, listen, if we don't spend, we're going to have unbelievable demand and we won't be ready. They're betting on the demand, but they know what the demand is. They can see that in their pipe. Now, speaking of something that I have wanted for a long time, subscription revenue. When we first started talking, it was in the 30s, then the 40s, and now it's 57%. This has fabulous gross margins. To me, this, of all the numbers that I saw tonight that would make me want to buy the stock in the mid-60s, it would be this subscription revenue number.
Yeah, you know, Jim, when I first took over, we said this was a journey we were going to go on, and we've made so much progress, and it's really hard to get people's head around it, but getting to 57% of our revenue coming from recurring streams gives us more predictability. It gives us more of our outlook becomes clearer to us. It's good for our shareholders because it gives them more predictability. And candidly, our customers are actually liking the consumption model because what it allows you to do is to provide continuous innovation to them. When they're buying something one at a time, they have to pay for the next thing to get that innovation. And when they have a subscription, you just keep feeding them new innovation and new capabilities, and so it's good for our customers as well.
All right, well, talk to me a little bit about Splunk. I always love their analytics, and I love their security. When you get a Splunk customer is now a better Cisco customer or maybe a new Cisco customer?
Yeah, so Jim, if you think about what's all the technology infrastructure that our customers use from Cisco, we can now take all of that data and ingest it into that Splunk platform that our customers have invested in. So our customers have a Splunk platform. Now they get all the security insights that they were getting from Splunk before. They get the security insights that they can get out of the Cisco security products. They get performance information that's occurring in the networking devices that they have. And now they have a complete view of their technology infrastructure. So when they have a problem, they can quickly determine, do I have an application problem? Do I have an infrastructure problem? Or do I have a cyber issue? And getting to that remediation more quickly is so important to our customers. And that's what we think we can do uniquely with the Splunk acquisition.
Well, I've got to tell you, Chuck, I was in favor of the acquisition. I know that without it, security wouldn't grow as much as I wanted. It's got to grow faster. That's able to do it. And I wanted that recurring revenue because it's ridiculous to pay only 16 times for recurring revenue with a good balance sheet and a company that is doing terrifically. I want to thank Chuck Robbins, Cisco CEO and Chair. Another terrific quarter, and Mad Money's back after the break. Thank you, Chuck. Yesterday, we continued Mad Money's Salute to Service on the heels of Veterans Day, where we take questions from veterans. We had so many amazing calls, we decided to continue the mission today. And why not? We should be commemorating vets all year, not just one day of the year. That's what my sergeant dad taught me a long time ago. So now it is time. It is time for the Salute to Service edition of the Lightning Round on Cramer's Mad Money. That's where I take veterans' calls, rapid fire. You say the name of the stock, I tell you what to buy, sell, so just clear to know the stock market. That time I grab it, and then the Lightning Round's over. Are you ready, Skid Daddy? Time for the Lightning Round. Let's start with Joe in North Carolina. Joe.
Hey, Jim, a big shout out to all my brothers and sisters at the Richards Coffee Shop in Mooresville. You all been recognizing and welcoming home veterans for over 30 years, and you're the reason I moved here. Hey, Jim, my question is American Waterworks. I was on your show about 6 years ago. And I just want to see if you still think it's a long-term hold. Or
I think it's fine. It's consistent. I mean, when interest rates go down, this tends to go down with it. But take a look at the long term. This one is pretty darn terrific. I like it. And thank you for service. Let's go to Justin in Pennsylvania. Justin.
Hey, Jim. Thanks for your continued support for the troops.
Of course.
Hey, my question's in regard to Amazon. Do you think that with more established tech sector companies introducing dividend payments, that's going to be a catalyst for Amazon to fall?
Well, I'll tell you, what's a catalyst for Amazon is that they are crushing it, I think, this holiday season. They've already, I have to tell you, these guys are doing so many things right. That last quarter was tremendous, but the key is Europe, and that's the delta that's going to move it higher. I want to go to David in Colorado. David.
Jimmy C, thanks for taking my call. My stock took a beating on their last earnings call. They've already recovered a lot of those losses. What's the future look like for Microsoft?
Oh, you know what? It shouldn't take a beating. I thought the neighborhood did a good job. I thought the sellers were wrong-headed. And you know what? The stock's starting to make you and me look good. Let's go to Brian in Florida. Brian.
Booyah, Jim. I served Line 7 in the U.S. Army in memory of my daughter, Anna Brooke Alverson. She had autism and nonverbal. So please give her a shout-out. My stock is AVGO. Thank you.
I give your daughter a big-time shout-out, and booyah, and I got to tell you, I'm thinking of her. All right, I'm pulling for her, and I'm also pulling for Broadcom, if I can be so meretricious to mix stocks up with health, but I have to because that's my job. I am a dollar sign represented by a man, and I do think that Broadcom should do well. I don't know whether Cisco is going to hurt it today with its light guidance because I think Broadcom is doing very, very well. Let's go to Michael in New Jersey. Michael.
Bing bong, Jim. They're making fun of me at the yacht, so I'm hitting them with the truth. Is it Holver for DJT?
You know what? It never really. It's kind of like owning a share in the Green Bay Packers. I mean, I don't know how they're going to do this weekend. They look okay. This thing is a very hard stock to value, and maybe it's a keepsake because I can't figure out how to put a number to it. That said, it sure does trade like a crazy one, doesn't it? Let's go to Bobby in Kentucky. Bobby.
Hey, Jim. Hello from the great state of Kentucky.
It sure is great.
I appreciate all you do for our military veterans that watch your show daily. Appreciate all the insight. My stock that I'd like to ask you about is FSK, Go Army.
Okay, now, Go Army. Army's pretty good team this year. Okay, so this is what's known as a business development company. It has a very big yield. But I do think that over time, you're going to wish that you did start peeling some off. That's what I want you to do. Let's go to Kenneth in Michigan. Kenneth.
Big booyah to you, Jim.
Man, you come into play.
Long-time follower of you and your show. Jim, I would appreciate your opinion about the third quarter earnings report released yesterday on SoundHound AI and what your thoughts are about the future of this company, please.
I was quite surprised that this stock got as crushed as it did. The quarter wasn't nearly that bad. I think if you buy this stock between 5 and 6, you get a nice trade. And that, ladies and gentlemen, is the conclusion of the Lightning Round. Tomorrow, midday, around noon, I'm going to be reviewing my charitable trust holdings stock by stock to figure out how they'll fare under the second Trump administration. That's the CNBC Investing Club monthly meeting. But I got to tell you, it's tricky. It's tricky because there's a tug-of-war in this administration between your traditional Republicans, pro-free market, and regulation, and Vice President-elect J.D. Vance. See, right now, the prevailing wisdom is that the FTC and the Justice Department, the two institutions with power over antitrust, the ones that can block mergers and acquisitions, will be much less hostile to deals than the current Biden regulators. No, look, I agree with that wisdom, and it's what I'm going to be telling you if you're a member of the club at our monthly meeting. Frankly, it's hard to imagine a more anti-business group of characters than the FTC's Lina Khan and the Justice Department's Jonathan Kanter, who runs the antitrust division. Oh, they were incredibly harsh to tech titans and brutal toward almost any proposed merger. From my perspective as an investor, this is all bad news for people who own stocks. Even in the rare cases where the regulators were justified, blocking mergers still hurts the stock market. Sell. Take the attempt by Justice right now to separate Live Nation Entertainment from its multiple venues from its Ticketmaster division. See, Live Nation CEO Michael Rapino is hoping and to some degree expecting a more sympathetic hearing from the Trump Justice Department. He figures there'll be a more traditional back and forth that's a little more congenial, less grandstanding. You know what? I think he's right. I think that's probably true. But maybe our assumptions are wrong. considering the voice of J.D. Vance, who's expressed tremendous interest in the Justice Department and is no friend of either big tech or big mergers. On antitrust, Vance is a populist. Take Google. Right now, Justice wants to break up Google because it regards the company as a monopolist. Earlier this year, Vance called Google, quote, one of the most dangerous companies in the world, end quote, and he said it should be broken up. In his view, Google is a left-wing institution. He doesn't want his ideological foes controlling the flow of information. I think that's a stretch. If Google's so left-wing, why the heck is the Biden administration trying to crush it? But who cares what I think? I'm not the vice president-elect. News reports this afternoon indicate that Trump wants Florida Congressman Matt Gaetz as his attorney general. Now, he too is an avowed critic of Google and has announced he wants them to obey the antitrust rulings previously brought by the Biden administration. Plus, one of the great paradoxes of contemporary politics, J.D. Vance actually said back in February that Lina Khan, that's the FTC commissioner, is, and I quote, the best person within the Biden administration, end quote, adding, I like a lot of things Lina Khan is doing, end quote. That's not faint praise, people. That's praise. He's called for bipartisan regulation of monopolists. And if left to his own devices, I think he backed Justice Department's suit to break up Google. Fortunately for shareholders, this will be the Trump administration, not the Vance administration. If you study Vance, you get an inkling of his anti-corporate bias. In Hillbilly Elegy, a local employer, Armco Steel, merged with Japanese company AK Steel and proceeded, Kawasaki merged to AK, proceeded to upend his hometown of Middletown, which in Ohio is a series of cost-cutting measures that, frankly, can only be described as rapacious capitalism. It's pretty devastating if you read it. He now seems incredibly wary of mergers that tend to throw many people out of work in the name of corporate profits. Now, at the end of the day, politicians are politicians. They can turn on a dime if it suits the current moment. But Vance's hard line about Google's supposed left-wing bias, that might strike a chord with President-elect Trump, who didn't exactly get a lot of support from big tech, did he? Now, that's why it's genuinely difficult to determine what's a Trump stock and what isn't. So you might want to curb your enthusiasm for Trump's antitrust regulators. All that said, the stock market did pretty darn well under Biden despite antitrust. That's why I say don't dwell too much about the FTC or justice when you make your investing decisions. Money will be made by us regardless. Just don't be surprised if the Trump antitrust regulators are a little more like Cantor or Khan than you could ever have imagined. I'd like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.